Good morning, everybody, and welcome to our third and final part of the Succession series, Life After the Deal. If you could add any questions that you have to the Q&A box, and we will get around to answering to them at the end. And thank you very much for joining us, and I'll hand you over now to Matt and Ella.
Good morning, everybody. Hopefully you can see and hear us both. Welcome to the final part of our series on succession here at ETC Tax. For those of you who've been with us throughout this series, you will have already have heard part one going through getting yourself ready for sale, selling of your business. Part two, the actual carrying out and the doing of the sale. And then we're here at part three, which is life after the deal. So we're going to be talking about things to think about once you've sold up, once you've effectively transacted that deal, and things that you might need to think about. Just a very quick point for those of you who haven't come across us yet here at ETC. We're a team of tax experts, and we specialize in particularly complex advice for a range of clients. We cover most taxes, not everything, but most, including and most importantly, income tax, corporation tax, capital gains tax, inheritance tax, stamp duty, and of course, VAT. We support both individuals and businesses directly, as well as other professional advisors, either through the project work or our Tax Partner Pro subscription service. If you've not come across our Tax Partner Pro subscription service before and are interested in finding out more, please do get in touch. I'll be more than happy to run through that with you. As I say, very pleased to welcome my friend and colleague Ella to this webinar. Ella, would you like to introduce yourself?
Yeah, of course. Yeah, thank you for having me. So my name's Ella Davis. I'm the founder of Ella Rose Financial. I'm a chartered financial planner and specialise in independent, bespoke, holistic financial planning. We shy away from product-led transactional advice and prefer to focus on clients' personal goals and objectives initially, with those puzzle pieces slotting in thereafter.
Excellent. It's always good to start with a disclaimer, I find, just to set the standard for the rest of the webinar. Just a very quick point. I'm sure most of you, if not all of you who are on this webinar, will be aware that there is a budget incoming on the 31st of October. So this webinar is delivered based on the rules and rates at the time of recording. Naturally, there may be some changes, particularly as there's quite a heavy focus in this webinar about IHT. We're obviously very aware that IHT is within the crosshairs of the new Chancellor. So some of the information that you find within this webinar may be shortly superseded, but at the time of recording, it is present and correct. There are obviously parts of this course that talk about the personal elements of life after selling your business. Both myself and Ella will touch upon that, and obviously they won't change, so do stay tuned. Okay, so life after the deal. You've already been through the heady process of finding a buyer, preparing your business for sale, going through the process of the sale, which can take many months, and now the deal is done, and we're talking about what happens next. So here you are, you're facing a brave new world. And in truth, it is and can be a culture shock. Both Ella and I have mentioned this in the past, that we see clients very regularly who are used to dealing with or used to being the boss, if you like, where all the weight of the business is on your shoulders, and now post-sale, that's no longer the case. You may well have a tie-in period to work for your business that you used to run that you now no longer do. And that can be quite a challenging period if you're not used to that. The adjustment of going from being the boss to being someone who is effectively an employee, in most cases, can be quite challenging, particularly around the nature of your continuing role. So in most cases, what we tend to see is that directors who have sold their shares remain as directors, or certainly in part, they remain as senior members of the board for the new business, so that they can pass on their wisdom of how the business runs, certainly in the short term. But generally, yes, it is important to note that it might be a little bit of a culture shock in the first place, going from being boss to no longer being the boss. I also want to just touch upon the impact of your post-tax income. Let's not forget that the majority of people who run their own businesses and the majority of owner-managed businesses have a director shareholder setup, where you would normally take a small salary and then top up your income with dividends. But if you're no longer a shareholder, if you've sold all of your shares, you can no longer take dividends. You also might not receive the same benefits that you had before. You may perhaps have had medical insurance and a car before. You might not be offered that as part of your new package for staying on within the business. And in addition, we see very often that directors use their company cash personally from time to time and have that additional finance available to them to sort of lean on when they need it. If you're no longer a director, indeed, of the business, or indeed part of the ownership structure, you might not be afforded the opportunity to have a loan account to fall back on. So again, referring back to the term, the culture shock of not having that type of thing available to you anymore. It's just something to think about. I've just run a quick example just so you can see, and in fact, I can't see because we're blocking the the text there. So in this example, Mr. Fevrier sold his business, Green Boots Limited. Prior to the sale, Mr. Fevrier drew a small salary in line with his tax-free personal allowance, and the balance of his £100,000 salary was taken as dividends. Following the sale, Mr. Fevrier will be kept on as an employee and will be paid a salary of £100,000. You can see in the example below the difference between the net take-home pay for Mr. Fevrier based on a salary dividend split, where you can see that the first £500 of dividend income is tax-free, and then rates of just 8.75% and 33.75%, as opposed to on the salary side of things, nothing at 0%, all of the basic rate band at 20%, and then higher rate tax at 40%. And then let's not forget, you will pay national insurance on a salary, which you don't do on dividends. So there's an additional cost there. The total cost is a little over £11,000 less in your pocket than you would have had you have remained a salary and dividend director shareholder. Practicalities of taking over or having gone through the deal is that you may be kept on as a consultant, and I use consultant, the term consultant lightly, as in a lot of cases, the consultant often just remains doing very similar work to what they were doing before. It's very important to be aware of the deemed employment rules when it comes to consultancy, and although the risk does lie with the employer in this case to assess your employment status, just because you have an agreement that says you're a consultant doesn't necessarily mean that you are, and HMRC might view it a completely different way. They will look at what's changed from before the deal to after, and if they will assess that the role now is more of master and servant rather than true consultancy, then it's likely that you'll be treated as an employee rather than a self-employed consultant. If, for example, you weren't kept on and you completed the deal, grabbed your money bags and ran away, then you might find occupying your time a little bit of a challenge. Not everybody adapts well to not working anymore, particularly entrepreneurs that we tend to deal with who are used to building and growing businesses. The thought of not having that business to grow can often be quite challenging. Potentially, new startups may be restricted by covenants in the share and purchase agreement. So you might be restricted from setting up a new business in the field of your expertise for a period of time post-sale. In which case, yeah, you may find that you are struggling to occupy your time. But of course, there are non-executive director roles in other businesses where your experience of running a business and growing a business and even potentially selling a business can be hugely valuable to growing businesses. Self-assessment tax returns will naturally change. You will have completed tax returns prior to the sale because being a director shareholder with the salary dividend example that we gave before, that all needs to be declared on a tax return. You will naturally need to complete a self-assessment tax return in the year that you sell the business, because you'll need to report that sale. But in addition to that, it's important to make sure that relevant claims and elections are made on that return, and those elections are made in a timely manner. We have seen occasions where people have failed to make the right elections on a tax return and been denied relief, such as business disposal relief, on a sale of a business. So don't be that person. Also important to not overlook earnouts and loan note redemptions on subsequent returns. You will have, if you've been on the earlier webinars, my former colleague Paul spoke about that not everybody gets all their cash up front. Indeed, quite a lot of deals include earnouts based on future performance and loan notes, so effectively IOUs that are cashed at a later stage. In some cases, you can apply or elect to not pay tax on the total proceeds, including the value of the loan notes at the time that you sell the business, in which case, when you cash in the loan notes, you will pay tax at that point. So it's important not to miss those on any future self-assessment returns, as potential penalties and interest charges for non-compliance or incorrectly submitted returns can apply. As part of a sale and purchase, warranties are a very big part of it. And obviously, hopefully, a claim against the warranties within the share and purchase agreement won't happen. But it's very important to make sure that that sales document typically refers to any warranty claim as a reduction in the purchase price. The reason that's important is that, let's just suppose that you'd agreed a sale for £1 million and there was a warranty claim. If the wording within the warranty claim was that you were personally liable for, say, a return of £50,000, then you effectively would be paying that out of your post-tax income or gain. Whereas if it's referred to as a reduction in the purchase price, instead of you being taxable on the £1 million proceeds, you would only be taxable on £950,000 of proceeds, and therefore you would be able to save or reclaim any tax overpaid on the sale. I appreciate it's only going to be 20% of the value, but 20% is certainly better than 0%. And it can naturally take several years for an event that requires a warranty claim to take place, and it can be a little bit challenging to get overpaid tax back in those circumstances. So we're very hopeful that that never is required. I haven't seen too many where warranty claims have gone through significantly later, but just be mindful that that is a possibility. Okay, so I'm going to move on to inheritance tax, which I suppose is the larger point. Once you've dealt with the capital gains tax on the sale, of course, inheritance tax is a very big matter, because now you're sat in your pot of gold, you effectively can be in quite a vulnerable place, can't you, Ella, from inheritance tax? Because effectively what you've done is you've sold your shares, which qualify for business relief or business property relief, as it's also referred to as. And that relief gives you a 100% relief against inheritance tax for the value of your shares. Now, if you've sold your shares and got cash on day one, that cash is immediately forms part of your estate for inheritance tax. So from one day, you might have £2 million worth of shares that have zero inheritance tax implication, whereas on day two, you have £2 million of cash, and all of a sudden, £800,000 of that cash is vulnerable to inheritance tax if you do, unfortunately, get hit by a bus or die in any other sudden way. It's important to note that loan notes and deferred consideration and even earnouts can be part of IHT liability once that deal has been done. So again, although the cash might not be received until you've passed away, the value of that cash still forms part of your estate. It may be worth considering pre-sale to gift some assets to your targeted beneficiaries. You may wish to gift some of the shares in the business to those beneficiaries directly prior to the sale. Firstly, the CGT relief will be available if it's the transfer of trading company shares. So if, for example, Ella and I let's just say I wanted to give some shares to Ella, providing my company was a trading company, there is a relief that I can claim for. In fact, it's a dual claim, which passes the CGT issue effectively onto you. So you would have to deal with it, which is fine by me. But it's important to be aware of potential impact on business asset disposal relief, because if Ella receives some shares, say 10 days before the sale, she's not going to qualify for business asset disposal relief on her shares disposal, because she's not held the shares for more than a couple of years, which is a minimum requirement. Gifts are generally classed as a potentially exempt transfer for IHT, but as mentioned before, subject to business relief, and therefore the 7-year clock starts ticking. Protection will be lost when the shares are sold, the business relief, but effectively you're potentially starting that 7-year clock earlier, which means that you might be well into a 7-year clock by the time the sale takes place, which then will help with long-term IHT planning. Of course, one of the potential downsides to pre-sale gifts is that the cash will be straight into the hands of the recipient on the sale of the shares, and whether that's desirable or not, particularly if you're looking to pass wealth down to children. If you don't particularly trust your children with a stack load of cash, you might not wish to do that. And of course, if your children are under the age of 18, any gifts to your minor children remain within your estate, irrespective of the value that you've transferred out.
Just one quick point, if that's okay, before we move on to this, and it's something that isn't either of our disciplines, but it's just something to be aware of. Obviously, there's a lot of succession planning that goes on with the sale of a business, and the likelihood is that you will have children or financial dependents or someone that you might want to involve in the planning. I would, now this sounds a little bit distasteful and a little bit unromantic, let's say, but I would get a family lawyer involved as well, and potentially consider having a prenup put in place just to try and protect the value of the family's assets, basically. If children were to then get divorced later on down the line, then potentially quite a lot of the family's assets could go elsewhere. So, as I say, it's not the most romantic or positive thing, but actually it's just a way of protecting the family's wealth, and it's just sensible. So yeah, as I say, not our disciplines, but I recommend speaking to somebody about that.
Yeah, a very good point. It's one thing that we see actually quite a lot when dealing with clients who have a particular high amount of family wealth, is the protection of that wealth against unscrupulous potential new family members. So yeah, a very good point, Ella. Thanks very much. I suppose one way of protecting against that potential scenario could be to create a trust, a pre-sale business property relief trust. Effectively, instead of gifting the shares to the individuals directly, you could gift the shares into trust instead. If you were to try and if you were to do this post-sale, you would actually be restricted to £325,000 per person of value into a trust without suffering lifetime IHT, which is a thing that not a lot of people know, that you can pay inheritance tax during your lifetime at 20%. If you gift the shares directly into trust pre-sale, providing they do qualify for business property relief by virtue of them being trading company shares, then there's actually no limit on that value. So you could move up to, say, £1 million worth of shares into a trust and not have a lifetime IHT to pay. When as part of the deal, the trust obviously sells their shares and pays CGT at 20%. It's unlikely to qualify for business asset disposal relief. There are some scenarios where trustees can claim business asset disposal relief if the beneficiary is also a shareholder of the business that is being sold. There's a number of different examples and scenarios around that. So if that's something you are considering, we'd obviously be able to look at that in more detail. But the general gist is that you wouldn't get business asset disposal relief, but in some cases you can. Cash after the sale is held on trust for the benefit of the beneficiaries, which is obviously protected until the time is right. Being within a trust would protect against things like claims on divorce or claims on bankruptcy. So along the point that Ella mentioned with the prenup, if the assets were within the trust, they were generally outside the scope of a divorce settlement. Also, obviously, it's outside of the seller's estate without that lifetime IHT, which touched on before. Although if the seller does pass away within 7 years, there's a possible clawback of that business property relief if the shares no longer qualify at the time of death, which is worth mentioning and important to note. Minor children, similarly as before, cannot benefit before they turn 18. They can obviously be beneficiaries of a trust, but you can't distribute any income or capital to those children until they reach the age of 18. Otherwise, you fall within the settlements legislation, which will see that income taxed upon you personally. And of course, one of the slightly negative sides to trusts is that trusts pay income tax at the trust rate of tax, which is equivalent to 45% on the income. However, when that income is distributed to the beneficiary can claim back any overpayment of tax. So if the beneficiary, for example, is a 20% taxpayer, they can claim back 25% of the 45% tax paid by the trust. One thing you may wish to consider is family investment companies. We have an awful lot of articles and content around family investment companies should you wish to learn more about these. Effectively, once the sale has taken place, you set up a company where you hold shares which give you rights to voting and dividends. Crucially, you then sort of cap your shares at a particular value. Then you issue a separate class of share, which is known as the growth shares, to your children or a trust for the benefit of your children, if you want that added level of protection. And then as that company grows, the value grows outside of your estate. In addition to that, when you put the cash in, you're effectively owed that cash back by the company, so you can draw it back out tax-free and spend it as you will. Tax planning 101 when it comes to inheritance taxes, of course, spend it all before you die, but that's not always quite as easy as it sounds. So you can also gift some elements of that initial loan into the company to your beneficiaries if you wish. Those will, of course, be potentially exempt transfers from inheritance tax, so you do need to survive for 7 years after gifting that loan. And another point, just in relation to IHT, is you can acquire insurance related to your IHT liability. Is that something that you'll touch upon, Ella? Yeah, so Ella will touch upon this slightly later in the webinar, but effectively there are insurance policies that you can get to cover your inheritance tax liability should you pass away within a certain period of time, referred to as decreasing term life policies. So further post-sale planning is you can, of course, reinvest the proceeds of your shares into new business property relief qualifying assets. That would obviously give you immediate inheritance tax protection because there's no 2-year holding period. Qualifying investments include AIM shares, other trading businesses, commercial woodlands, etc. You may also wish to consider, particularly if you've got high levels of income, things like EIS and SEIS qualifying shares, because not only can you roll over the gains into these types of shares and qualify for business property relief on those, but they also come with some quite nice income tax reducers, which will reduce your overall liability in the year you make the investment, or indeed the year before. So if you had a particularly large amount of income in the previous year, you might wish to make some investments into EIS or SEIS and then carry that investment back to get some tax relief there.
That's quite important, isn't it? Because you've actually, whilst the income tax reliefs are there and they're available, you actually have to have the earnings to have paid the income tax in the first place to be able to claim it back. So if, for instance, you were working last year, but this tax year you're having a year off post-sale, you won't have any, unless you take on another role where you're paying income tax, then you won't actually have any income tax, depending on your circumstances, obviously, to be able to maximize that income tax relief claim. So yeah, it's important you know about the carry back option, and speak to your tax advisor about that.
So I suppose the key message when it comes to inheritance tax is to have a strategy in place before the big day. Don't risk 40% of your hard-earned proceeds should the worst happen, I suppose. Or at the very least, stay away from buses and other potentially life-threatening issues. Okay, so I'll pass you over to Ella now. I'm going to talk a little bit more about what you can do with the money that you've got once you've got it.
Yeah, so the first point I want to make, and as Matt said at the start, there'll be a little bit of crossover with our presentations because there are some common themes in terms of some of the softer facts, let's say, when it comes to money, like the psychological aspect of it all, rather than just the metrics, the actual sort of pounds and pence and percentages, etc., that are the obviously very important factors, but I think you need to take stock, really, and this is an important life event. So it's not just about the numbers. You need to really take a minute, basically. It's perfectly normal to feel uneasy about the lack of regular income that's coming in. This is something I see with some of my retired clients as well, actually, not just business owners who have exited, because we generally spend our life earning money and having a level of income coming in at a regular point throughout the year, and that is something that our brains get used to. So moving from that environment to actually having a sum of money in the bank can be a little bit, it can make some people feel a little bit uneasy, and it's quite a lot to get your head around. So it sounds like such a simple thing, but I wouldn't underestimate it. But the main message I would say is that actually this capital is there to be drawn down on. You don't have to say, oh, well, I want to get X amount of growth or X amount of interest to then live off the interest or the growth. The capital is there to support you. It's just flipping it and thinking of that as your regular income, if that makes sense. Yeah, take some time to decompress, consider your next steps. It's really important that you take a minute and just think about what you want the next stage of your life to look like. When it comes to putting a financial plan in place, everyone is completely different. You might think that you look very similar to another family and have like the same objectives, and you want to live your life in the same way, etc. And financially you might look fairly similar, but believe me, we're all very different, and we all have very different views on money. Some people don't worry about inheritance tax whatsoever. They couldn't care less. Other people really do worry about it and don't want to leave any sort of burden or any sort of problems for their children and the next generation, etc., and want to have all their ducks in a row. Same for mortgages. Some people worry about their mortgage, other people are not bothered at all. So just an example that we're all very different. So it's important to think about that when you're thinking about the next stage of your life and what that might look like. In that respect, I can't stress this enough, and this feeds in from the other webinars in the series. Start planning early on, not just with your advisors in terms of the the business structure and earnouts, whatever that might look like, but from your personal finances point of view, sit down with your spouse, sit down with your family, and start planning early on, because there's so much to think about. There's a lot around business exits in terms of what is like the number. That number can be very different for everybody. If you do some financial modelling with a financial planner beforehand, it really helps with preparing you psychologically for what's coming up in the next stage of your life. It's not such a big bang moment and you think, oh right, what now? But doing the financial modelling before can actually help you potentially in like the negotiations of the business exit as well, in terms of what that might look like for you and your family. You might feel that you need a huge amount of money, you really want to push and keep getting the most out of their exit. But that might come at a cost in terms of you might have to carry on working for another 3 years. And as I say, everyone's different. All of our circumstances are different. You might, whatever your family structure is and your position is, it might not be the best thing for you to do, to carry on working at that high level for, that extra period of time. If you were to maybe take a lower offer, then what would your life look like? Is that sufficient? So these are the sorts of things you need to have a think about. Pension funding, again, this is going to be a common theme throughout this. As I've mentioned before, with the EIS and CDIS comment about the income tax release, it's the same for pension funding, really. You need to have what are called net relevant earnings to be able to make any sort of decent pension contribution, really, and then claim those valuable reliefs back. We'll get into that, the more detail there later on, but again, it could look different for everybody in terms of what your structure will be going forward. As Matt said, you might have a form of consulting, different earnouts in place, etc., etc. If you're consulting, what does that look like for you? Will you set up your own limited company to then invoice through and, try and keep that sort of barrier and, classification that you are a true consultant, in which case, again, there's other things you can do with your pension funding. You could then make a company contribution directly from the limited company, perhaps. Again, utilising family members' allowances. This is probably something that you could do as part of the wider exercise in terms of the succession planning, potentially bringing other people in with family investment company, for instance. The key thing, as we said before, inheritance tax position will change overnight. Obviously, this is all subject to the current legislation at the moment. I think we're going to be following up maybe towards the end of the year with another session, perhaps, if there's a need for it post-budget. But yeah, at the moment, your inheritance tax position will change overnight. So it's just important to be aware of that. Matt's already touched upon company benefits ending. The key thing with private medical insurance is that if you've got pre-existing conditions, so in that you've claimed on that, or your family members have claimed on that insurance previously, then it's very difficult to then get new insurances that cover those conditions again going forward. If you were to start the process again, in terms of setting up your own personal policy, then there would be various different exclusions, and you'd only really be covered for new problems that the insurance company would be happy to support. But yeah, anything pre-existing, it's better to try and maintain that private medical insurance. So they will give you the option of continuing it. So just be mindful of that in the chaos of everything that's going on. Keep an eye out for that letter that comes from Bupa, AXA, Vitality, any of the other insurers that provide the PMI for you. They will give you that option.
Presumably that would be if the insurance is with the company rather than a personal insurance that's paid for by the company.
Benefits. Yeah. Generally, when people, even if they were to just leave employment, the insurance company will give you the option of continuing the cover and paying for it personally. And 9 times out of 10, you could carry on, all of those previous conditions through. It will just be a cost to yourself. So let's say it's happened, you've got the money in the bank and you're looking at your bank balance and you're thinking, my word, that looks very healthy. What do I do with it? It's you've worked very, very hard for this money. You want to make sure that it's safe. So a couple of points to note, there's no rush. Make sure that the money is in a position where it's safe, that will give you some breathing space, basically. So I would recommend that you have a look at the FSCS website, which is the Financial Services Compensation Scheme website. So usually they will provide you with a standard level of protection of £85,000 per person per banking license. That's a really important thing to check, the banking license, because there's been so many sort of consolidations, amalgamations in the banking world. Some of the banking licenses cross over, so you might think that they're different, but they're not. So that's really key. They may, if the worst was to happen, and this is, quite an extreme scenario, but never say never. If the banking institution does fail, then you may be able to apply for a temporary high balance cover, but that isn't tested until the point the institution fails. Again, this is very doomsday, worst case scenario, but it's just going to give you that comfort that the money is safe, temporarily before you decide what to, actually do with it. Another one to look at is national savings and investments. So whilst this isn't covered by the Financial Services Compensation Scheme, it is 100% backed by HM Treasury, and their accounts are actually quite good. You can put in, there's premium bonds. So each of your spouse, each of you or your family members can put in up to 50,000 into premium bonds, and you never know, you might win and, create some more wealth. and that would be tax free. But then there are other accounts where you can put in, up to 1 million in some, up to 2 million in others. And so again, use those allowances for each of you and spread the money around basically. So sorry, I muted us then. So there are the websites. If you wanted to make a note of them, obviously the slides will be available after this morning. So as I said, next stages in terms of planning, take stock. Once you've got that money safe and it's set aside, give yourself a minute. Consider your life in stages, so short, medium, and long term, and formulate your goals for each. So that is going to look very different for everybody. In terms of building a financial plan, I would definitely say, engage with your financial planner and do that early on, so that you can actually, start formulating these things and start processing stuff. The financial products, in terms of where you actually put the money thereafter, consider those as puzzle pieces. So they will be things like pensions, ISAs, etc., which I'm coming on to on the next slide. But it's very much that should be secondary to the process. You will, I expect, have a lot of people approach you post-sale or even pre-sale if people get wind of it. Your bank will be the first one. They will have their wealth manager on the phone asking for an appointment to talk to you about whatever they offer, etc., etc. But the financial products should definitely come after you've had this conversation in terms of where you want to go with your life and what you want your journey to look like, because then they are the puzzle pieces to basically help you achieve those goals. As part of that, I would recommend assessing what level of investment risk you need. As I say, you will probably get lots of people call you up and say, oh, we can get you, X% of growth every year, which, amazing. But with that growth may come some investment risk. So given your particular circumstances, you might not need to take as much investment risk as that. You have to be comfortable with it. Again, we're all different. Some people are comfortable, some people aren't. Inflation risk is a huge thing. So the compound effect of inflation, I can't stress it enough. It really does eat into your wealth over the years. Obviously, we're coming out of a high inflation period at the moment. It goes up and down just like the markets. It was just a spike. Things are starting to sort of stabilize now. But yeah, I mean, as we've all seen with the cost of living recently, your money just doesn't go as far as what it used to. So yeah, that's my biggest piece of advice really, is that cash is only a temporary position. Cash is there to be spent, basically. You need to try and get yourself an above inflation return, especially if this money is going to need to support you and your family for a long period, because the compounding effects over time are huge. Now, you may have already accrued some sort of financial products, some savings, some investments, some pensions, some insurances. I always say that these types of investments of financial products, they're just like a laptop or a mobile phone or a television. There are new things coming to the market all the time. So an upgrade, if you think of it in that way, it might be needed. So it's a good time to take stock of what you've got at the moment and where that is. It might be best to move things around as part of the wider financial plan as well. Again, insurances. So personal insurances, you may have taken out some stuff from, when you were a lot younger, when you had a higher mortgage, when your children were younger, and obviously more financially dependent on you. You might not need to pay for that insurance anymore. You might be overinsured in a certain area now that you have this money post-exit. So that's really important. You don't want to be spending money that you don't need to spend. So in terms of, once you've got that financial model in place, you've gone through a budgeting exercise, which is really important because, again, it's all relative. Some people, I know some millionaires that still fight to get on EasyJet flights and, queue up super early so they don't have to check in their baggage and all of that kind of stuff. And it's just because it's just how they've been brought up, it's how it's ingrained in them. They want to get value for money. Whereas some people might think that's absolute madness. If you know you've got a lot of money in the bank, you don't want to be flying in an EasyJet and doing that kind of thing.
All the terrible airlines are available.
Yeah, absolutely. Yeah, Ryanair, don't get me started on them. But yeah, just an example, really. We're all different. So the budgeting exercise is really important. You need to try and have a think about what your lifestyle will look like post-exit. You've worked extremely hard, so you might want to have a couple of years where you just go on holidays, you treat family members, have a bit of a blowout, buy yourself a nice car, whatever it looks like. It's all absolutely fine. It's just to understand what those short-term expenditure items are. And also, if you've got children that are going to university, or you want to help them get on the property ladder, all of that kind of thing, it's important that these additional bits of expenditure are built in, and then they can be structured accordingly, because you want to make sure that actually what you're spending is an appropriate level. It's not going to run out too soon, basically. So in terms of combating the effects of inflation, as I say, you really do need to invest some money. I always refer to getting your ducks in a row to start off with in terms of the basic building blocks. So these will be cash, having an emergency fund, as I mentioned, spread it around, only have enough cash there that you need to have for the next couple of years, basically, bearing in mind that budgeting exercise that you've done. In terms of investments, you can then split out again across family members, potentially each spouse. That's the general course of events. Each of you use your ISA allowances. That's 20,000 a year currently. Pensions, this is where it gets a bit tricky in terms of how much money you can put into the pension, and the different benefits with them. Again, they're very, very efficient from both a retirement and estate planning point of view at the moment. The reason being is that pension funds sit outside of your estate for inheritance tax currently. Full of disclaimers today, but yeah, at the moment they're very, very efficient. So personal pensions are never going to be a wasted asset. Basically, they're there for you to enjoy in your retirement, and you can be very tax efficient with getting money into them, and then very tax efficient with getting money out of them in terms of all the flexibilities on how you can access them. You can manage how much of that money is taxable, etc., and vary that each year. And then, depending on when you pass away and what your circumstances are and what your pension provider allows you to do, that's a key point, and that's why it's important to review. The estate planning side of things it's amazing as part of your overall financial planning, really. So I really hope they don't make too many changes to pensions in the budget, because there is this dual kind of purpose for them at the moment. Another thing that may be subject to change is capital gains tax. So outside of ISAs, you can then, another one of the building blocks is what's called just a general investment account, which is effectively like a trading account. Historically, we've been able to be really efficient with that and transfer money every year from the general investment account into an ISA. It's something that's called a bed and ISA. It helps basically crystallize small gains every year and then get that money from a taxable environment into a tax efficient environment in the ISA. However, obviously, capital gains allowances are quite small now at the moment, and we'll see what happens. It may not be that that's an efficient use of some of the money, but it does work. It helps not, sort of accrue too many gains within a portfolio over the years doing it that way. And then we've got an investment bond. Now, again, investment bonds, there's lots of different varieties. There's lots of different ways it can be set up. So you do need some advice. This is where it starts to get into a little bit more complex planning. This can be quite useful when you're talking about succession planning as well, because it can be used to provide a tax efficient income for both yourself and also your beneficiaries. A trust arrangement can easily be wrapped around the bond. Now, you can have an onshore bond or an offshore bond, and I know that sounds a little bit, people might wince at that, an offshore bond, but it is perfectly legitimate. They're just housed in like the Isle of Man, for instance, and then you benefit from what's called gross roll-up on that. So it's a very tax efficient way of growing your fund, which can then be distributed either back to yourself tax efficiently or to your beneficiaries as well. Now, this is where we get into sort of more esoteric kind of investments, and you'll see on the next slide we have got some sort of warnings here, really, because the next three investments on the slide there are really only suitable for certain people, in that we've already utilised all of your other allowances. We have assessed, what level of investment risk you need to take to achieve your objectives and how much you can afford to lose. So what's called your capacity for loss, basically. So you should only really invest in the next three types of investments if you're fully aware of all of these risks, because they are, whilst they're backed by the government, if you Google them, the gov.uk website will come up. So they are completely legitimate, but they're not regulated by the, and so they're not covered by the Financial Services Compensation Scheme. So I'll just run through these quickly. So so each of the next three investments, VCTs, EIS and seed EIS, they are all basically backed by the government, and they are designed to bring in investment into fledgling UK companies, basically, to help the economy grow. So as a result of that, they are higher risk because they're not that well-established firms. They're not like the ones that you'll see on FTSE 100, Marks and Spencer's, for instance, that kind of thing. They are smaller companies that are going through different rounds of investment. So venture capital trusts are very good from a diversification point of view. I mean, just to digress slightly, diversification is a huge part of your overall planning. You don't want to have all your eggs in one basket at all. There's valuable income tax relief of 30%, up to 200,000 you can put in each year into a VCT. So again, going back to what we said before, you have to kind of make sure that you have that, that level of earnings to start off with, really. The other thing to note is that the gains are tax-free, and the tax-free dividends as well are really important. They can be quite nice, those dividends. They could be like 5 or 6, maybe 7 or 8% in some cases I've seen. So they can actually support you in retirement as well. Yeah, you can't do the carry back option with the venture capital trust with VCT. So it is just the year in question. I'll quickly run over the EIS and the CDIS, which Matt's already talked about those, but yeah, there's, again, diversification purposes. You can put in more into EIS. It's actually up to 1 million. And there's different things you can do in terms of deferring capital gains, etc., etc. Again, you get 30% income tax relief on that. But I would stress that this is only really, a small part of the puzzle, really, and it should only really be funds that you're willing to sort of watch fluctuate, and there might be some losses within the portfolio. You do get capital gains loss relief on those, so it's not a complete waste. And when you crunch the numbers, it's still quite efficient, but it's something to be aware of. And CDIS is very similar, but it's even more higher risk because they are much smaller companies. The CDIS, you might be able to get 50% income tax relief on those, and you can only put in, let me refer to my crib sheet here. Is it 200,000? Oh, yes, yeah, I thought it was 250. Pardon. That was a test for Matt. Yeah, so it's not as much as the enterprise investment schemes, but still an important piece of the puzzle. So this is important. We do need to have these disclaimers in that they're very, very useful. I use them all the time for my clients, but not for everybody. So yeah, we do need to be aware that all investments carry risk. Okay, so other points to note. Your planning needs to be kept under review. So if you stand still, it's just like sort of being on autopilot. If it doesn't consistently correct itself, you eventually go off course. Obviously different legislation changes, etc. Different life events. We all have different views on how we feel about different life events, etc., etc. It all feeds into your planning. The fees element, now this is quite important because just like inflation, the fees that you pay within your investment portfolio are really, really important. So I would take note of the advice fees that you pay. These industry standard is a percentage fee of the assets that you invest. I personally charge a fixed fee because I feel like it's a little bit more transparent and not as conflicted. But there are other product and investment charges as well that you need to be aware of, that again, over time, just like inflation, the compounding effect of that will really affect the amount of growth that you get within your portfolio. Build a professional team around you, collaborative work, supportive network. These are all things that you need to consider. Matt and I, when we're talking to a client, we need to make sure that we are on, the same page. The left hand knows what the right hand is doing, because otherwise some of it can cross over, and it could quite easily, it could just combat all the good work that each of us are doing. So yeah, it's really really important that you get that supportive network around you. And then the other point is really just enjoy your wealth from an inheritance tax point of view. Spend money, enjoy it, but only if you know that the money that you're spending isn't necessarily needed. Now that sounds very frivolous, but that's where the budgeting and the financial modeling comes into things. But yeah, it's important that you enjoy your wealth, because that's your beneficiaries can't get taxed on something that isn't there anymore, can they? So that's one way to think of it. One point I've not covered off that I did say I was going to is insurances for inheritance tax purposes. So as Matt said, you can get a decreasing term assurance policy that would effectively taper down over the 7-year period, which is effectively the standard in which you could get caught out, that if you were to gift some money to your children, say, and then you die within that 7 years, there's a tapering of that tax that would be due. So you can get various different insurance policies. There's one called a gift into vivos policy that you can pay for it, and it will basically cover any tax due over that 7-year period should you pass away. So there's ways around these things, but again, it's important that you consider all of these things as puzzle pieces. It's not one size fits all, definitely not. And then we have some regulatory information that will be available on the slides when we send them over.
And that's it. Thank you very much to everybody for attending this morning. That was very informative, Ella. I really appreciate you coming in and joining us on this webinar. If you do have any questions, hopefully they've been coming through during this event. If you do have any questions that you get at a later date, our email addresses are shown below, and hopefully you were able to connect with us on LinkedIn using the QR codes earlier in the presentations. If not, we're both on LinkedIn quite a lot, aren't we, Ella? Mm-hmm. So do find us and connect with us on LinkedIn. Next up for me, I will be talking about a subject that will no doubt cause Ella to shiver. From an investment perspective, cryptocurrencies.
Oh, yeah.
Incredibly high risk from an investment perspective, but very popular. And I'll be sitting and talking about the tax implications of crypto. I certainly won't be giving any advice around investing in crypto, I can assure you. Sarah, are there any questions for us?
Yes, we've got a few questions that's come in. First one is, can I just clarify the point around getting the hit by a bus scenario? Once the deal is done and the cash is received, if you die suddenly, the full value would be within the estate for inheritance tax?
Yes, exactly that, unfortunately. Yeah, as I went through slightly earlier in the presentation, yeah, if you get your £2 million from your sale of shares and it's yours, if you then have an accident the very next day and pass away, that £2 million is within your estate. There's no tapering or allowance for that, unfortunately. So yeah, that would be obviously a very extreme scenario, but one that is indeed possible.
Another question, what is the maximum you can put into your pension, and why is timing so important?
Okay, so pensions are complicated things. So you might think that, right, now you've got some money post-sale, then let's put loads in a pension. You've heard how tax efficient they are, etc., etc. It's not that easy in terms of the timing, as I touched upon in the presentation. So you need to actually have what are called net relevant earnings to be able to contribute to a personal pension, unless you are a company owner or company director, in which you can actually, that doesn't necessarily matter, you can make a company contribution, which tends to be what most business owners do. But say there is no business now and you have no earnings, the maximum you can actually put into your pension without any net relevant earnings is only 3,600 gross per year. So that's actually only £2,880 net that you will be able to contribute into a pension. So, it's a drop in the ocean, really. So that is why the timing is really important in terms of how much you can put into a pension. in theory, because you can carry back unused allowances from the last 3 tax years, in theory, you can put in up to £180,000 each into a pension. And that's using this year's allowance, which is £60,000 plus the previous 3 tax years allowances. Now, this is where the complications come into it. And this is where you really do, I can't stress it enough, you need to get some advice, and your tax advisor needs to be in contact with your financial planner, because it's all very much, it varies in terms of there's a various different threshold incomes, which you need to be aware of. And depending on where you fit in your overall earnings, then that affects how much you can put into your pension. And it can be tapered down all the way from £60,000 down to £10,000. Now, those earnings thresholds are very complicated. So, and it's important to note that it's not actually just what you pay yourself through the company or what your salary is. It's actually P11D benefits, dividends as well, even though they're not classed as net relevant earnings, they are included in this calculation. But also any property income that you might have, rental income, anything, any other consultancy work. It's basically everything that goes on your tax return needs to be included in this calculation. And then, just to complicate things further, depending on what type of pension contribution you make, whether that's an employer pension contribution or a company pension contribution, or perhaps a personal contribution that you make out of your own funds, then those pension contributions get added back into the calculation, and they have the effect of changing those threshold incomes. So it's very complicated, basically. So yeah, you do need some advice, but if you know how much you can put in, then it's really worthwhile doing so, because the tax reliefs are great.
Absolutely.
Perfect, thank you. Another question is, on the trust you spoke about, is there a 10-year charge?
Yes, there's 10-year charge on all trusts now. They only used to apply to discretionary trusts pre 2016, I think it was.
What year we're in.
Interesting possession trusts pre 2016 didn't have 10-year anniversary charges, but all trusts now are subject to anniversary charges.
And then the last question we've got here is, how might someone who is staying on after sale improve their net pay? The example earlier showed a significant decrease in take-home pay for the seller.
Yeah, that was one of the points why I was keen to include that slide, was that, you know, what people have in their back pocket is really what's most important, and the difference between getting salary and dividends versus a salary is very significant. I suppose that can potentially form part of any agreements that are made as part of the sale. You know, an increase in salary perhaps to ensure that whatever net position you need in terms of your earnings going forwards is what you agree. That obviously would include an increased salary in this scenario, which would then have other tax implications like losing your personal allowance, etc. So I'd definitely say that it's worth, again, pre-planning and getting advice on that. It's not as simple, straightforward as I used to get 100 grand, I now get 100 grand, therefore it's the same. So again, definitely take advice in relation to what the outcome will be after the deal based on what is being proposed in the agreements.
And again, going back to that, you know, working collaboratively with your advisors, your tax advisor can work with your financial planner and work out exactly, you know, how much you can put into your pension, because that will help you regain your personal allowance depending on what your earnings are. So anyone earning over 100,000 loses the personal allowance, but a personal pension contribution can bring that back down. So again, that's a conversation that it would be good to have together with your different advisors to make sure that, you know, just optimizing your position.
Perfect. Thank you, guys, and thanks everyone for joining us today. Don't forget to keep your eyes open for our next free webinar, the Tax on Crypto, on the 17th of October. Thank you, everybody, and we will send the recording out within the next week.
Great. Thanks, Sarah, and thanks to everyone who joined the call today.